One of the stocks that I own in my dividend stock portfolio, my number one favorite stock of all time, Johnson & Johnson, it is tanking. It is literally in free fall. This stock tanked 10% today, and my subscribers have been asking me all over social media, on YouTube, on Twitter, on Facebook, everywhere, Ian, what do you think about this falling stock price in Johnson & Johnson? And I want to address that today, and I also want to address some other news and recent subscriber questions. So get ready. It is going to be an exciting video about dividend growth investing. So I want to jump right into it. Johnson & Johnson, it fell $14.84 today, or 10.04%. According to some reports I was reading online, this is the biggest single drop that Johnson & Johnson stock has faced in a long time. I think all the way back since 2002. And the reason for this drop is a lot of drama right now with baby powder and asbestos. Apparently, there are allegations against Johnson & Johnson that some people may be facing horrible things, cancer, because of Johnson & Johnson's baby powder. Moreover, there are reports surfacing that are implying that Johnson & Johnson knew. They knew that there was asbestos or amounts of asbestos in their baby powder. Now, I am completely unfamiliar with this situation. I have no idea who is in the right, who is in the wrong. I will allow the legal system, the lawyers, the company, the people making these allegations sort it out. But needless to say, anyone facing cancer out there, my heart goes out to you. That is a horrible, horrible thing to be dealing with. And it is just so sad that in modern times, it seems like cancer is affecting so many people. And I would venture to guess that most people watching this channel, either through their family, their friends, their business network, we probably all know someone, unfortunately, that has faced or is facing that terrible disease. And so, anyways, I do not know what will come of all this, but needless to say, my heart goes out to anyone facing these kinds of challenges with cancer. Now, as it pertains to Johnson & Johnson stock, which is a stock that I own, obviously, the stock market does not like uncertainty. There's a lot of uncertainty right now. The stock market, the investors do not know how all of this will play out. Will there be more class action lawsuits? Will Johnson & Johnson be on the hook? Will they have to make payouts if it is proven that, in fact, these people making the allegations are accurate in what they are saying? I know there's already been one judgment brought against Johnson & Johnson that was ruled by the court that J&J is going to owe money to certain people. Now, Johnson & Johnson is appealing that decision because they believe it was not an accurate decision. We will see over time how all of this plays out, but certainly there is a lot of uncertainty with J&J right now, and that is being priced into the stock today. It's down 10% in one single day. So I want to put some context around the recent Johnson & Johnson drop. So I always diversify in my personal stock portfolio. I own 39 stocks now. We'll get to that in a minute, not 38 anymore, but I own 39 stocks. And J&J, yeah, it's my biggest position. It's 8.2% of the portfolio before the drop. And that being said, I own 38 stocks aside from Johnson & Johnson. The beauty of diversification is, even though it was down 10% in one day, the biggest drop it's had since 2002, and even though it's the biggest stock in my portfolio, I still only lost 0.82% of my portfolio value today from this drop, because 10% of 8.2% is 0.82%. And so this is the importance of broad diversification. This is why I diversify. This is why I do it. Of course, I do not invest for capital appreciation. I invest for dividends. I want to get to this in a minute because I'm getting a lot of questions about this. And I think it helps put a lot more context behind this situation, but I'll defer that to a little bit later in the video. So more context. I started buying J&J at $58 in 2011, 58. Even after the drop, right now it's at $133. I'm up 129% on my initial tranche. even after this drop. And so the story here, quite frankly, in my opinion, is despite this baby powder drama, I, again, don't know how it will play out. I don't know who's right, who's wrong. I will leave that to the powers that be to figure all of that out. But despite the drop, this thing has already gone up a lot. And even in 2018, it's gone up a lot. And so my question becomes, did it fall today because of the baby powder? Or did it fall, quite frankly, because the stock got a little bit ahead of itself? And look, forward PE, let's look at that for a minute. For 2018, the analysts are estimating for 2018 that they earn $8.16 per share. If I take the $133 share price, I divide by 8.16, I get a forward PE of 16.29. 16.29 seems like actually a pretty darn good PE for J&J, a reasonable PE. I would say not a steal by any means of the imagination, but a good PE for a growth company, for a company growing its revenue, growing its earning, growing its dividend, a world-class brand, a world-class big company, not a bad PE. And so before this drop, the way I kind of look at it is maybe it got ahead of itself a little bit. Maybe this is just the market kind of pricing risk. Maybe this is the market starting to correct, starting to even crash in some respects. Now, I don't want to scare anyone. I did a video on the upcoming market crash. I'll share in the description below. I think we are in for some scary times ahead, at least in terms of the stock market going downhill. Now, scary, but also very exciting, very good, because as a dividend investor, as stocks go down, bargains appear, starting yields are higher. I reach my financial freedom quicker because I invest for the dividend checks. And I know in the long term, 10 years out, 20 years out, I will be doing just fine on capital appreciation, just as I have on J&J, up 129% on my initial tranche, despite all of this drama. And so I start just thinking with all of this, this is really a tale of two markets right now. I just did a video on some companies on my watch list. By the way, I bought one of them, Apple. We'll talk about that in a minute. But two of the companies on the watch list have been just facing terrible, terrible pressures. I'm talking about General Mills and Kraft Heinz. I own General Mills, by the way. Both of these are facing terrible pressure on their stock prices. And I really see this kind of as a tale of two markets. This is what I'm seeing now. Companies that are pristine, that are amazing, that have no issues at all, like J&J before the baby powder drama, they are being priced at extreme premiums, at prices, quite frankly, that I don't want to purchase them at. I'm talking about most of the companies in my top 10 stocks of all time. I'll link in the description below. Most of those these days, they're priced to perfection. I don't want to buy them at these levels. However, there's a then everything else bucket. I think what's happening here is anything that has any kind of uncertainty, such as a General Mills, a Kraft Heinz, now a little bit of J&J, the market is just punishing them. It is totally punishing them. So it's a tale of two markets now. There's the premium stocks, the non-premium stocks. I like the premium stocks, but I only want to buy them at bargain prices. It seems like J&J, it's kind of between the two buckets now. It's not a deep value, it's not a deep discount, but it's kind of starting to get into that territory where maybe I'd consider buying some more. Probably not at 133, but if it got down into the 100 in teens or maybe the mid-20s, yeah, I would consider buying some more, adding to my position in J&J. And so again, I think this is the tale of two markets playing out. I don't know per se if it really is the baby powder asbestos stuff causing this kind of correction, or more that it just got ahead of itself. The market is looking for any kind of imperfections and just punishing the heck out of those stocks. And quite frankly, we're starting to be in a correction. I've done a video, I'll link in the description below, on the upcoming crash. I think there are some turbulent times ahead. I think that's really good for dividend investors. And I think it's going to be hard for a lot of dividend investors who have not been through it before. But I am used to this kind of stuff. I do not mind falling share prices because, again, I know in the long run, the share prices will be up. And I know in the short run, as they go down, I get better starting yields, more cash flow. I reach financial freedom quicker. So more stuff on J&J, more context. On the same day that they faced this horrible ordeal, Pfizer, another company I own in my portfolio, raised its dividend. They raised their quarterly dividend from 34 cents to 36. It's up 6%. So I got a raise from Pfizer for doing absolutely nothing. This is the beauty of stock market investing for dividends, and how when one looks at things more holistically, it really is a fun game. Because J&J, look, I'm down 0.82% in one day for my overall portfolio. Not that exciting, not really fun to lose quote-unquote money on paper. But that being said, I softened the downward pressure through smart diversification, and quite frankly, now that it's heading down, finally, one of my top 10 stocks, maybe I'll be able to buy it in 2019, because I wasn't buying this thing. I'm not even buying it at 133, but if it gets down lower, I will buy it. I will buy more. So there's that. But just putting in context, same day I get a raise for literally doing nothing. So the message here, in my opinion, is in the long run, it all works out. And the questions I start asking myself about Johnson & Johnson are right here. Is the dividend safe? Yes. Are they going to recover? Yes, they will figure it out. Was the stock perhaps overpriced? I think it probably was. And quite frankly, will they continue to raise the dividend? Yes. Putting this in more context, I own other stocks in my portfolio that have faced massive lawsuits. When someone invests in a publicly traded company, one of the risks that investor takes on is the publicly traded company that they own, it faces issues, it faces lawsuits. And I think pretty much every publicly traded company out there at one point or another has probably had to deal with legal issues. That is the risk of being a large company. And so I own a company called BP, an oil company. They faced a horrible tragedy with the oil spill, and there were a lot of legal ramifications that came out of that. And look, fast forward to 2018, they have recovered, they have figured it out. It was a horrible tragedy. Everyone wishes it never happened, but it did. They got past it. If you follow my recent videos, I'll link in the description below. I just shared a free guide on my SIN stock portfolio. I own all the SIN stocks. And back in the day, they faced a lot of legal trouble, horrible legal trouble. They got past it. The whole industry got past it and is now recovered. And so you could apply this example pretty much to any stock out there. And so putting it in context, they're facing some troubles now. Will they get past it? Yes. And I'm not trying to say that in a way like, will they get past it and wrong the people that are facing these challenges? Not at all. I believe that it will all be sorted out. The lawyers will be involved. The people facing their health challenges will be involved. The company will be involved. Everyone will sit down. They will face it out. They'll face it together. The system will work. They will all get past it. And so that is just how I look at this company right now. But yeah, dividend safe. I don't lose any sleep over a 10% drop in a single day. And I want to now move on to Apple, because I think the reason a lot of my subscribers are asking me about J&J is for this very reason. They didn't buy it back at $58. They bought it before the drop. They bought it recently. One person was mentioning, I bought it yesterday and now it has tanked. Well, here's the deal. I am so excited, by the way. I just bought a stake in Apple. MacBook Pro box. I just had to buy it because I owned it before. I sold it to invest in an angel company. I always wanted to buy it back. Finally, I got back in. I love the company. I use all of their products, and I use them pretty much for all of my waking hours. And so how can I not invest in the company that empowers me to do everything I do, to film and edit these videos? If I did not have my Apple products, this YouTube channel, I wouldn't have perhaps the same quality of the videos that I have now. So I'm very grateful for all the Apple products that enhance my life, and it's a really well-run company, and it's growing. It's at a forward PE in the 12 range, and they are growing. So great bargain basement value that for a growth stock. Anyways, I bought some Apple yesterday. Fast forward to today, guess what happened? I bought at 171. It fell 3.2% today. It's now at 165. The deal here is this is what happens. I think it's kind of the curse of being a investor, quite frankly. I feel like this happens to me a lot. I'll go out, I'll buy a stock, the next day it will tank. But the thing is I bet you back when I bought J&J at 58, I probably bought it, next day it tanked. But you fast forward through time, it just doesn't matter, because dividend investing is about investing for the long term. Dividend investing is about looking decades out. It's about looking, quite frankly, not really at the share price in the short run, because I never plan to sell. Even if Apple doubles or triples from here, it's not going to do me any good. The only good that it will do is it's probably, if it does triple, it's a reflection of the company doing well, meaning the company's making more money, meaning the company can raise my dividend, pay me more cash flow that I can use to pay the bills. That's really the ramification of a stock price going up. Other than that, in the long run, in the short run, the stock price doesn't really do anything for me because I never plan to sell. And so a lot of investors, you are going to face this. You're going to face this more than you ever had before, because I really do think this correction that's starting here, it will continue. It may not continue right away. Maybe we're looking a year out, 2 years out, 3 years out. At some point, we will face a very severe correction, in my opinion. And as you're buying, as I'm buying, the next day, it will always be down. But the fact of the matter is, no one knows where the bottom is for the market. No one knows where the bottom is for an individual stock. And so what I like to do is diversify. I've got 39 stocks, but I also like to average down. And so when I bought Apple, I actually bought a big starting position. It represents 0.4% of my portfolio now. I want it to be up to about 1%, 0.9%, somewhere in that range. So what am I going to do? I bought my first shares, and I'm hoping in January of 2019 that it stays low. Maybe it goes even lower. I will buy more. And so I like to average. I like to average in, and I'm buying stocks every month, and I will buy all the way down, all the way back up. That is why I dollar cost average. And I am just warning the community, quite frankly, that this is what's going to happen. This is going to be more the norm. 10% drop in J&J. It could be any of my top 10 stocks. This, in my opinion, is going to be more the norm. This is what's happening. We've historically been in an overpriced market. It's starting to correct. But the lessons here are, at least for myself, is not to be scared and to... I'm certainly going to be averaging down and enjoying the drops because I get higher starting yields on my money deployed. And I know in the long run, it will all come back. So real excited to have Apple in the portfolio and to join a lot of you out there who also have Apple, who have been asking about it for a long, long time. So I also want to fast forward here and kind of share another insight today. So there are two types, and I'm kind of jumping around today because I'm getting a lot of questions recently. By the way, thank you everyone for supporting me on YouTube, on social media. I love all these questions in the questions section below. You guys are the best. Keep them coming. I'm getting a lot of questions on Facebook, on Instagram, on Twitter, and now, by the way, I have a Patreon. I'll link in the description below. This is for people who want to support me financially. I am getting some questions through there as well, and I'm just trying to address all of the questions. And so this video today is really a three-part series. It's J&J, it's Apple, and now the next one. But it all links together. This is why I'm kind of bundling it today, because all of these philosophies, they link together. They are all relevant for dividend investors. So the third thing I want to share today is this question, hey, I got a lump sum of $25,000. I want to live off of it or use it to supplement my income. I want to literally use the dividends starting tomorrow. I don't want to wait a year. I don't want to wait 10 years. I want it now. I need the income now. And so there's really two types of dividend stocks. There are dividend stocks that have really high starting yields but low growth. I think General Mills is a good example of that. There are stocks, though, that have a really low starting yield like Apple, but high dividend growth. So the person who literally needs cash flow tomorrow, they're not going to want, in my humble opinion, to look as much at these low-yielding stocks like Apple, because being able to live off of these sub 2% dividend yields, it's just not going to be enough cash flow if one wants to retire, start supplementing bills starting tomorrow. And so if I'm just taking hypothetical situation here, if I inherited, say, $25,000, I was going to deploy it tomorrow, I needed it to the cash flow to supplement my bills, here's what I would do. I would focus mainly on the types of dividend stocks that pay a higher dividend that have lower dividend growth, because that would give me more dividend yield. Now, I'm talking about stocks like utilities, I'm talking about stocks like General Mills. I'm talking about stocks, probably like Cedar Fair is another good example, stocks that pay a higher starting dividend yield but have a bit lower growth. What I would also do, quite frankly, is because I am hypothetically retiring on this money tomorrow or using it as part of my retirement, I can't subscribe to too much risk. And so probably what I would do with 25,000 is I would spread it evenly across 25 stocks. I would put 1,000 in 25 different stocks. The reason I would do that is stuff happens. Could I have ever guessed that J&J would drop 10% today? No. If I have 25K and I put it all in J&J and then this happens in one day, that's just too much risk, especially if I'm at that stage in my life where I need the money to live off of. And so to answer this subscriber question, hypothetically speaking, if it were me, I were retiring tomorrow and I got a lump sum, I would divvy it up real evenly across a lot of stocks, probably 1,000 in each, and I would pick stocks that are across a broad array of industries, and I would pick stocks that have high current starting yields. Now, the other reason I'm actually answering this question is I've been getting some comments here, and people are kind of commenting, Ian, some of these dividend stocks you own, the revenue is not growing, like General Mills. These stocks in general are not going to do well. They are going to be on the decline over time. And there's a lot of people, it seems, in the investing community, they subscribe to this philosophy. If the revenue is not growing, the company, it's done with. It's done with. Don't even touch it. Now, in general, I do prefer to invest in companies with growing revenue, growing earnings, because it means the dividend can grow over time. And because I'm not retiring tomorrow, I'm retiring in the future, I like dividend growth companies, companies that are growing the dividend quickly, because whereas I am foregoing income now, generally speaking, when I do need the income, I'm going to have a higher yield on cost if I buy the dividend growth companies than if I buy the high yielders. That said, I have a bunch of high yielders in the portfolio. I have a lot of companies like General Mills, like utilities, where the dividend is high right now, but it's not growing very quickly. And some of them, it's not growing at all. My personal philosophy is I like to diversify, not only by number of stocks, but by market cap, also based on international geography, but also based on dividend yield. I like some of them that are the fast growers, like Apple, and I like some of them that are the high yielders, slow growers, like General Mills, and I like some of them in between, like Johnson & Johnson. And so my personal philosophy is that these companies like General Mills, yeah, they may not be growing very quickly, but you don't really need to. A company, just because it's not growing, does not mean it's going to go out of business. All a company has to do is stay pretty even. It can stay pretty steady as long as they optimize their costs, as long as they pay down their debt, as long as they manage the company well, and they keep that dividend steady. It doesn't even have to grow. If it's yielding a 5% starting yield on something like a General Mills, by the way, I expect it to grow over time, but the point here, in my opinion, is just because General Mills is not growing the dividend very quickly right now, if at all, until this Blue Buffalo acquisition is figured out, that's okay. It doesn't mean they're going out of business. And I think a lot of people start thinking the stock price is going down. It's always going to be going down. This is some of the psychology of something like a J&J. I bought J&J yesterday. It went down 10% today. There's other people. I bought General Mills. I think it's always going to go down. I think it's going to go down to zero. That is simply, in my humble opinion, not the case. This is a different kind of market than any of us have seen in the last probably 10 years or 9 years. The last time this kind of market happened was during the Great Recession. So we're starting to see a down market. And so these stocks that are going down, they will not always go down. In General Mills, it's not going to go to zero because they are not growing revenue. A company that is not growing revenue, quite frankly, it's already priced at a PE of around plus or minus 12. It's already priced as if this company is not going to grow. Maybe it could go down to a PE of 8, 9, or 10 in the worst case if we hit a catastrophic market collapse. But certainly a company that's not growing, world-class brand, solid, stable, reliable dividend, it's not going to zero. It is just the fact that we were in a different kind of market now than we were before. What's exciting, quite frankly, is we're in a better market now for anyone that's accumulating shares, for someone that is building a portfolio, because the prices are progressively better, which means progressively better starting yields, more cash flow, more income. So anyways, thank you everyone for those amazing, amazing questions. They truly, truly mean the world to me. Thank you. And so before I leave today, a full disclosure, I own the stocks mentioned today. I am long. I own Johnson & Johnson, ticker symbol J&J, Pfizer, ticker symbol PFE. Cedar Fair, ticker symbol FUN. General Mills, ticker symbol GIS. Apple, ticker symbol AAPL, my new edition, number 39. Hey everyone, I forgot to mention I am also long on BP. I own BP, ticker symbol BP, in my personal stock portfolio. In terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest money in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube, my personal journey for fun and entertainment. Thank you so much, everyone. We are 18,000 dividend investors strong. We're getting really close to that point where I'm going to share my complete stock portfolio with the community. So I'm really excited about that. It's really fun. I'm going to share all the positions. Although if you've been here a while, you already know all my positions. I guess the new info will be the precise weighting of every position in the portfolio. So something to look forward for everyone in the community. Thanks, everyone. I'll see you in the next dividend investing video.